Okay, lovely. I've decided that maybe this will be an effective way to study if I take my notes in the next 30 minutes that I have before I have to leave and just go over them. So this is for the midterm for Accounting 370, the second exam. So the first topic we covered is topic 6, which is all about receivables. And there's two ways to transfer receivables. The first way is through secured borrowing and assigning of receivables, which uses receivables as collateral. So you keep the receivables on your books and you continue to collect money from customers on those receivables, and that's what's used to repay the loan. So what you do for the journal entries for secured borrowing is you credit first the note payable. Why can't I? Ooh, hold on. So you first credit the note payable, and by doing that, you put that for the full loan amount that you're getting, and then you're going to debit the interest expense or the financial charge expense for whatever the financial charge percentage is, times whatever your amounts receivable collateral is, so whatever you're giving up as the collateral, and then debit cash. That one's a plug, so that was why it doesn't have anything here. You're just going to plug that amount so that the journal entry balances. So that's the first journal entry. And then the second one that you'll do is when you receive cash on your accounts receivable. So when you receive your cash on those accounts receivable, you're going to debit cash and credit your accounts receivable. And then, like I said before, when you have secured borrowing, you continue to collect money from customers and you use that money to repay the loan. So you're going to debit the note payable for whatever the amount is of cash that you received, debit your interest expense, which is just interest expense, loan times interest percentage times time, and then credit cash. And again, you're going to plug that in just like how you did for cash up here. Then the second way of transferring receivables is through a sale of receivables or factoring, where the buyer of receivables takes responsibility for collecting on them, and you can either sell them with recourse or without recourse. So let's start with the without recourse example. So example A is without recourse. So first, I like to credit, oh, I'm on pen, hold on. Oh, hold on. Erase that. Thank you very much. Okay, now we're back to the pointer. Okay, so first you're going to credit accounts receivable for the total accounts receivable amount that you're giving up. Then these two are like things that you plug. So first let's do the receivable from factor, and that's going to be the amount that you retain, which is given, times the total accounts receivable, and then you're going to do the finance fee times the total accounts receivable. So it's similar to the interest expense. Financial charge up here is equal to the same equation as the loss on sale of accounts receivable for when you're doing a sale or factoring. And then again, plug in for the debit to cash. And then the example for with recourse is a little bit different. So first, credit AR again, that's the same. Then you're also going to credit the recourse liability, which is an amount that will be given to you. Then cash is going to be the same as it was if you had an example without recourse liability. Everything's gonna, these three are going to stay the same. The only things that are going to change is the recourse liability that you're adding in, and then the loss on sale of accounts receivable. The loss on sale of accounts receivable is equal to this amount from before, so it's the finance fee times the total accounts receivable plus the recourse liability. So that's what's going to balance your journal entry, is by adding that. And that's just an example of that. So next, topic 7 is inventory. This one I'm a little worried about. So goods in transit, there's two methods to do that: FOB destination and FOB shipping point. I'm gonna check myself before I look. FOB destination is when the title switches when the buyer receives the goods. So when they physically have them is when it's put on their balance sheet as an asset as part of their inventory. And then FOB shipping point, title passes when it's released to the carrier. So as soon as it's shipped, then whoever the buyer is has it in their inventory. Goods on consignment, the consigner, the company that like made the product, will always have it in their inventory, not the company that physically holds it. And then goods under a purchase agreement, the seller retains control of inventory. Sure. And then the initial measurement of inventory is an equation we have where the cost, that initial measurement of inventory is the cost to acquire plus the cost to prepare those goods for sale. So it's like whatever it was to buy it itself plus the cost to prepare it for sale. Then there's two inventory systems. I'm pretty sure we mostly worked with perpetual for this exam. So periodic uses temporary accounts, whereas perpetual, you use the inventory and cost of goods sold accounts and directly and continually adjust them. Cost of goods sold, I messed this up on our homework problem. It's beginning inventory plus purchases minus ending inventory. I think I forgot the beginning inventory when I did it. So it's beginning plus purchases minus ending. And now we have FIFO and LIFO. I feel like those are pretty common sense, at least to me they make sense. So FIFO is first in, first out. So the first goods that you buy are the first goods that you sell. So the older goods that you bought first are your cost of goods sold, whereas in LIFO, last in, first out, the goods that you just purchased are going to contribute to your cost of goods sold. So your cost of goods sold are more accurate in LIFO, and your ending inventory is more accurate in FIFO. Yes. Um, and then these all like these assumptions of like higher and lower is all if you assume there being higher prices. And then LIFO inventory is FIFO inventory minus the LIFO reserve, and LIFO reserve is a contra asset to inventory. And then when you're changing from FIFO to LIFO, you're going to debit your cost of goods sold and credit the LIFO reserve. Topic 7, I want to look at a couple more examples of actually. Let me pull that up really quickly because I'm worried about the journal entries for topic 7, but there's like none in here. Okay, just because I want to look at the perpetual inventory system. So you debit inventory, credit accounts payable, obviously, when you buy the inventory. Shipping charges, so that's part of your inventory. Pay the account balance on June 11th. Oh, so that's because they had the terms 210 net 30. So they got 2% off, right? Yes. So they got 2% off because it was the 210 net 30 and they paid within 30 days. Or they paid within 10 days. So they got 2% off. So this was the accounts payable, but they paid less than that in cash. And the difference goes towards inventory because we're using the perpetual and not the periodic system. And then on June 15th, you get returns. We return the inventory. So credit our inventory because it's going down, debit to cash. And then we don't know if it's 100 or 98 because we don't know if it was the discounted goods or not. Okay, lovely. I think that was the only thing. I wanted to make sure I understood those journal entries. Okay, fantastic. That was all for that. Debit cost of goods sold. Credit LIFO. Journal entries are gonna throw me for a loop, man. Okay. Dollar value LIFO, I feel like I got it down, so I just like making the little table where we have the year, the ending inventory current, the ending inventory in the base year, so you divide it by whatever the price index is, the layers that you divide up, and then you just calculate the dollar value LIFO inventory by adding up the layers. Yeah, that makes sense, right? Ending inventory current, divide it by price index to get the base year, separate it into layers. So like layer 1, we still have layer 2. Yeah, I understand it. Yeah, hopefully, I don't know. I really get that one. Lower of cost or net realizable value. So this, I think this depends on if it's a periodic inventory system or a perpetual inventory system, on which of those you use. Or I guess it just, oh no, you can just do either. It just depends on which one you want to do. So you either debit cost of goods sold and credit inventory, or you debit inventory loss and credit inventory, for whatever the lower of whatever the difference is between cost and lower of cost or net realizable value. And then for the lower of cost and net realizable value table, we have the item, whatever the cost was, which is the historical cost, selling price, the cost to sell, and then net realizable value is selling price minus cost to sell, and then you just find the lower one. And if the lower is equal to the cost, then you don't have to do one of these correcting journal entries. But if this is lower, if net realizable value is lower, that's when you do the journal entry to either cost of goods sold or inventory loss. Cool. Now topic 8, property, plant, and equipment. So a lot of capitalized costs, which are going towards assets, capital expenditures. These are all costs necessary to acquire and prepare it for use. Installation, taxes, shipping, legal fees, setup, calibration costs. Then it's expense through depreciation. We have land improvements, equipment, buildings, self-constructed assets, and CIP, all sorts of stuff. And then lump sum prices and basket purchases, you allocate the price to each asset based on what percentage its value makes up. Do that as a percentage of the cost you purchased it at. Cost of asset purchased on credit is either the fair value of fixed asset acquired or the present value of the future debt payments. Sure. And then you debit asset, credit, note payable. Yeah, or like whatever is payable because you're purchasing it on credit. Cost of asset purchased when equity securities issued is based on the fair value of the securities issued or the fair value of the fixed asset. Yes, I think it just is dependent on like which one you can access. And then that one you debit the equipment or the asset, credit common stock, and credit additional paid capital. This one I'm a little bit worried about. So you're debiting the asset because you got a new asset because you purchased it with common stock. And so that's equal to the fair value of the equity, which is the share price times the number of shares. That makes sense. The credit to common stock is the par value times the number of shares, and then additional paid capital you plug in. So like we had an example where the par value was 1 and the share price was 10. So if we had 100 shares, 10 times 100, you would get 1,000 for the fair value, but the par would be 1 times 100, which would just be 100. So then this would be 900, or like 9 times 100, the difference between the share price and the par times the number of shares. Cool. I want to look at this example again, the purchase on credit. Let's see here. See, we didn't even do an example of that, so I highly doubt we'll get tested on it. Okay, whatever. Debit the asset, credit the liability. Cool. All right. Topic 8 continued. So the amount of interest capitalized. Okay, this one I kind of understand. The first step is you calculate the actual interest. You're going to separate it into specific debt and general debt. Specific debt, you take the loan times the interest rate times time, so probably a year. And then for general debt, take the other ones by their percentages, whatever. And then you do the WAIR, which is the weighted average interest rate, which is the interest on the general debt over the general debt. And then hold on to that number for later. Calculate the weighted average accumulated expenditures, which is each capitalized expenditure times time. So break it down into the months that those were made. Compute avoidable interest. So you take the specific debt times the specific rate. So that's the same as like when you did the specific debt up in step 1. And then plus, actually, no. So it could be specific debt, or technically it's the amount of specific debt that contributes to the weighted average accumulated expenditures. So if WAAE is less than specific debt, then just do the total of WAAE in this one. Whereas otherwise, you do all of the specific debt times the specific rate, and then you do whatever the rest is left over and the WAAE times the weighted average interest rate that you calculated, also in step 1. Then you find whichever is lower, and then if avoidable interest is lower than actual interest, you debit the asset for that amount, credit cash for the actual interest amount, and debit interest expense for the difference, the amount capitalized. Yeah, that makes sense. Yeah, interest expense would just be the difference. Whew. Maintenance and ordinary repairs, you expense. Debit repair and maintenance expense, credit cash. Improvements and replacements, you capitalized. Additions, you capitalized. Debit building, credit cash. Disposal of PP&E, credit a gain, debit a loss. Because a gain is like a revenue and a loss is like an expense. Cool. Book value is the purchase price plus the cost to get ready for use minus accumulated depreciation. Slide. And then steps to record the disposal of an asset. First, you record and update depreciation. So debit depreciation expense, credit accumulated depreciation. And then this one, what? Oh, then this is the rest of it. That was just an example problem. You credit the asset, debit accumulated depreciation, debit the asset gain. Oh gosh, that's a lot. So just debit the new asset, debit accumulated depreciation, credit the old asset that you're getting rid of because you're getting it off of the balance sheet, and that you always do at book value or historical cost. The accumulated depreciation is given. The new asset you do with the value of like whatever you think the approximate value would be, and then it'll either be a debit to loss or a credit to gain. If there's commercial substance, you can do a loss or a gain. If it lacks commercial substance, you only do losses. So if, let's say this lacks commercial substance, you would redo this if this has a gain. Get rid of the gain, and then you just plug in the new asset value instead of finding what do you think the value would be based on what you're given. Does that make sense? Just have to make sure also to write off the depreciation. Okay, sure. Ooh. Topic 9, depreciation and impairment. The net book value is equal to the cost minus the accumulated depreciation, depreciated at straight line, so cost minus residual value over useful life. And then you always debit depreciation expense and credit accumulated depreciation. Sorry, I was getting a call. For partial year depreciation, you take a fraction of the months in the year and then do the same thing. For changes to the depreciation estimate, you're going to change that prospectively. You're not going to change past financial statements. So then you just take the current book value, the revised residual value, and the revised remaining useful life, and then calculate it going forward. To correct a depreciation error, you do have to restate that. But since it changed your net income, you have to restate it through retained earnings since the income statements accounts have been closed. So you'll do either of these because if you overstated your depreciation, you need to lower your accumulated depreciation. Since accumulated depreciation is a contra asset account, yes, accumulated depreciation is a contra asset account, so you need to lower the contra asset account by debiting it. You would debit it and then credit retained earnings to increase your net income. Or if depreciation was understated, you're going to credit accumulated depreciation and debit retained earnings. Then for asset impairment, you have to do 2 tests. First, the recoverability test, which is you impair if the recoverable cost is less than the carry value, and the recoverable cost is the total estimated future cash flows. So if the book value is greater than that recoverable cost, then it has to be impaired. And then the impairment test, impairment loss, so the amount you're going to impair the asset for, is the carry value minus the fair value. Slay. And then like if you pass the recoverability test, fair value should always be less than carry value, I believe. But we'll come back to this because it applies to goodwill as well. And then the journal entry for that: debit impairment loss, credit accumulated depreciation. Topic 10: intangibles and goodwill. So the purchase cost of goodwill is purchase cost is capitalized. If an intangible asset has a finite life, you capitalize the cost and it's amortized over straight line method. If it has an indefinite life, it's not amortized, but you just review it for impairment. And then you're gonna use the journal entry of, debiting amortization expense and crediting the intangible asset. Patent and copyrights are amortized. Legal costs get capitalized, so you add it to the asset. research and development costs you expense, but once you reach technical feasibility, then you capitalize. I don't know. Goodwill is not amortized because it has an indefinite life. So the value of goodwill is the purchase price minus the fair value of net assets, which is fair value of assets minus liabilities. And then you do impairment testing. So if fair value is less than book value, then you have a loss. And the loss is equal to book value minus fair value. And then you're going to debit impairment loss and credit goodwill, which is the same as here, just goodwill instead of accumulated depreciation. Lastly, topic 11. First, we have gift cards. We have 3 journal entries we went over for that. The first one is the sale of the gift card. Debit cash, credit your deferred revenue from gift cards. Using the gift card, debit that deferred revenue from the gift cards and credit your sales revenue. And then if those gift cards expire, you have breakage revenue, which you're going to credit, and you're going to still debit and cancel out that deferred revenue. And then contingencies. So if you have a loss that's probable, reasonably probable, or remote, and then if you can estimate the amount or if you can't estimate the amount. So if it's probable and you can estimate the amount, you do a journal entry to record the liability. If the loss is probable and you can't estimate the amount, disclose it. If it's reasonably probable, whether or not you can estimate the amount, you disclose it. And if it's a remote chance of loss, then regardless, there's no disclosure. I'm trying to think. I'm really just worried about these journal entries, so I'm going to go back and review them one more time. So if you're doing secured borrowing, debit cash, credit note payable for the loan amount, debit your financial charge expense or interest expense. Then you receive cash and then you pay it off and you pay your interest expense. Sure. Sale of receivables and factoring without recourse, cash, debit receivable from factor, which is the amount retained times AR, debit the loss on sale, which is again that finance fee, times the total AR, and then credit AR. And then it's the same thing for with recourse, except you have the recourse liability, and that increases the loss on sale. Inventory, debit cost of goods sold, credit LIFO reserve if you're going from FIFO to LIFO. And then lower cost of goods sold and net realizable value, you're going to debit your cost of goods sold and credit your inventory, or debit inventory loss to credit inventory if your net realizable value is less than cost. Capitalized cost. If you're issuing equity, you debit the asset for the fair value of equity, credit common stock for par times the number of shares, and then credit additional paid in capital. All of these I think I understand. Debit the asset, debit interest expense, credit cash. Maintenance and repairs expense. Who's texting me? Additions, you capitalize. Book values, purchase price, plus blah, 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 blah. Gains are credits, losses are debits. To record the disposal, first you have to update your depreciation. So debit your depreciation expense and credit accumulated depreciation. Oh, so yeah, like if you're getting rid of an asset you slept and it's like June, you have to do like January through May of the depreciation has to be added into your depreciation. And then you do all of this stuff to record the actual asset exchange. Yeah. Definitely, that's the asset, accumulated depreciation, asset, and then loss or gain, but no loss or gain if it lacks commercial substance. Debit depreciation and credit accumulated depreciation. If you're correcting an error, you have to do it through retained earnings, either through debit or credit. Debit impairment loss, credit accumulated depreciation. If you have impairment, debit amortization expense and credit the intangible asset directly. You don't do it through accumulated amortization. You just do it directly through the asset. Debit impairment loss and credit goodwill. So it's like similar to here, but again, you're using the asset instead of accumulated amortization. You just take that loss to to goodwill. And then gift cards, credit cash, debit cash, credit deferred revenue, credit sales revenue, debit deferred revenue, credit paid. I think I kind of understand